There are a handful of persons I teach how to trade the Forex market, and these are either people that know me or people that know someone that knows me. And these are the 5 trading tips that I have given to them that's bringing them insane results. I'm about to open your eyes wide to some very simple yet neglected successful trading tips that no one really talks about. But hold on, let's just say someone else has talked about these things, and let's say you've heard some other persons talk about these things. Then I bet they haven't really broken things down and explained to you in details the way I'm gonna do for you in this video. Stay with me. I'm going to put you through all of these 5 tips, but before I do that, I want to let you know this. You see, trading is hard. It's a hard business, and not that no one or anyone can click the buy or sell button, but it's what goes on immediately before you click that buy or sell button and after you click that buy or sell button. When you're in the trade, the things that go on in your head, in your mind, your emotion, your thoughts, your mentality, your psychology, those are the hard things in trading. And I can't really begin to explain to you all these things right here in this video, because that's gonna take this video way longer than I expected it to last. So I'm just going to stick to these 5 tips, and they are going to help you if you put them into use. So let's go. Number 1, do not focus or trade just one instrument, and at the same time, do not focus or trade so many instruments. Now, this might sound contradicting, but it is not, and let me explain. You see, trading one instrument means just choosing one instrument to trade, and every day you come to the market, or every time you come to the market, you have to wait for trade setups to happen. And of course, trading one instrument will not always give you trade setups every time. In as much as it helps you to maintain your psychology, emotions, and every other thing, it can also help mess things up for you, in the sense that it can cause you to make bad trading decisions due to lack of patience. Imagine when you open the chart for days and you don't really find trades to take, and your hands become itchy and you just want to make money. I know, of course, this is a psychological thing, and then it prompts you into making bad decisions. Now, that is the negative side of trading just one instrument. Now, let me tell you what I mean by do not trade so many instruments. You see, trading so many instruments will also give you or put you in the state of confusion. Okay, picture this. Imagine you having a list of 20 instruments, for example, that you analyze and you potentially trade, and you go to 1, 2, 3, 4, 5 instruments. You see they are forming some sort of trade setups for you depending on how you trade, and then you decide to move on to other instruments to analyze. Then you analyze them all down to the 20th one, and then you didn't really find trade setups to trade immediately. Then you went over to the first 5 you analyzed, and you saw that they are still in the process of completing your trade setup, so you really have to wait. And then all of a sudden you start coming down after a while to the other 15, and then it suddenly looks to you like 1 or 2 or 3 of them amongst the 15 has a trade setup and you just want to trade. Then you enter the trades, and a few minutes later they start going against you. An hour or 2 later they are still against you, and you're just patiently waiting for the trade to go in your favor. But then after 2 hours, you go back to the first 5 you analyzed, and you saw that the trade setups were completed and the trade actually started moving really fast in your direction. That's one negative effect of trading so many instruments. So I am going to tell you just the way I tell the people I teach how to trade. Just keep it something between 4 to 7 instruments max that you trade. Now, this is going to help you concentrate your mind, your focus, your attention, your energy on those 7. 7 is just very easy to go over and recycle the process of analysis or going over them every time you open the charts. Just look for trade setups, look for your confirmations, and then look for your entry points. But keeping it above 7 or anything more is always going to put you in the state of confusion, and that is what you don't want, especially as a beginner trader. Even as a professional trader, I'm sure that is what you don't want. So keep it simple. Do not trade one, do not trade many. Make sure you have just a handful of them that you can always rely on to give you trades. And remember, it is not a must that you will trade every single day. But because you keep it simple, you're always going to find trade setups that will give you profits. And now, tip number 2. Do not trade related instruments or instruments that are in the same jurisdiction. Now, what do I mean by this? For example, you have Euro USD, you have GBP USD, you have AUD USD, you have NZD USD. These are instruments that are in the same jurisdiction, meaning that they can move the same direction at the same time. Even though I don't really believe in instrument correlations, I believe every economy or every currency has to do what it has to do at its own time. Now that's why sometimes you find that Euro USD, GBP USD, or any of them is just in a consolidation. AUD USD might just be running to the skies or falling to the pit, and the NZD USD might just be having choppy moves. So that's why I don't really believe that there is correlation existing in all of it. But that's really a topic for another day. That's if you want to hear it though. But what I'm saying is that these instruments tend to move most of the times in the same direction, and you don't want to include 4 of them in your basket of tradable currencies. Remember, I talked about leaving them at between 4 to 7 instruments. So 1 or 2 of them max is okay to be in your tradable instrument. Now, same goes to USD JPY, USD CAD, and USD CHF. You don't really want to include these 3 in your basket of tradable currencies, because if you buy or sell in one and repeat the same position or direction of trade in the other, you could be losing in this and also be losing in that. So you don't really want to do this. You want in a situation where you can be able to manage your trades, knowing that your trades are not really on the same related or category or jurisdiction of instruments, and then this will bring your psychology down to managing trades individually based on the direction they're going. Now, same goes to JPY pairs. Even though I don't really believe there is correlation, but you can go to the chart actually and verify this, that sometimes some of them might be going up and some might be coming down. They all might be coming down at the same time, but some will have choppy moves or be in a correction, consolidation, or accumulation phase, however you call it, and others are just running up or falling deeply down. So now that you've known what I really mean by instruments in the same jurisdiction, it is very important to choose just 1 or 2 and make your trading very simpler and effective. Point number 3. Be a student of psychology and do not try to teach the professor itself, which is of course psychology. Now, what do I mean by this? Picture this. Imagine you being in a school, like let's say high school or tertiary institution, college, whatever, and then you're not really following the curriculum of the school, of your course, of your program, but doing things, trying to teach your professors or your teachers what you think they should know or what you think they should be teaching you. You see, that will not work. Students actually become better by following the curriculum, following the teachings, following the topics, and reading along, even though they might read ahead of their teachers and professors. So what do I mean by this? Be a student of psychology and never try to teach the professor itself, which is the psychology. So don't trade hope, basically. Don't say the market is supposed to do this and then you become firm in that decision. Listen, the market is always dynamic and it can go either way. It can go both ways at any time, and that is why traders lose money. If everybody can easily determine or figure out that the market will go certain way and 100% sure always every time, then everyone would be making money. But people lose money because the market can go either way anytime, and that messes your psychology. Again, being in the market and looking at your trades, go in negative, come into positive, go in negative, come into positive, and then start going into negative the more, dipping down the more, giving you the red numbers is always so psychologically alerting, especially when you haven't built your psychology or haven't really been a student of the market and of psychology for a long period of time just to master and understand how the market works. You are always going to freak out. Even if you are an experienced experienced trader, but you are risking way much of your account size in single trades, because you are also going to be in these whole psychological fantasies, butterflies and fears and every other thing you can think of when the trade is going against you. So this boils down to managing your risk, being patient, knowing when to exit a trade, knowing when to be in a trade, knowing when to hold a trade. And I say this, make sure you're using good risk management always, as this will help stabilize and subsidize your psychology level. Tip number 4, and this one is also related to what I said last. Take risk management seriously. Make risk management your friend. Greed is real, FOMO is real, emotions are real, and every other thing that comes in between as a negative factor that hinders you from being a successful trader. All of these are real, and that is the sole reason why over 90% of traders blow their money. Okay, make risk management your friend. This will help you long enough in this game. I know so many people have the urge to trade and earn the whole money in the world in the same day, but that's not going to be possible, because this will mess your psychology. It will freaking mess your psychology up. If you can't do it, just don't try. Risk management is going to keep you longer enough in this business. For example, let's say you risk 0.5% on each of your trade. Now imagine how long you're going to be in trade before you eventually lose your account totally. Let's say you're trading a prop account and you have a 100k account and you risk 0.5% of 100k on each trade, or 0.5% of your balance on each trade. Imagine how long you're going to stay in the business before you eventually lose that account. Of course, you are going to need between 16 to 20 trade losses for you lose your account. That's depending if your maximum drawdown is 10% or 9% or 8%. That's why you need between 16 and 20 trades to lose your account. And I always say, if you lose 1, 2, 3 trades in a day, in a row, you can just pack up. Tomorrow is another day. Now imagine picture this. You targeting just $1,000 per day every day, which of course you're not really going to win every day, but just let's say every day, and you take just 3 to 4 trades maximum per day, which will bring you to 1.5 or 2% of your capital every day. If you win 2 of the trades, targeting 1 to 2 risk reward, you've obviously made $2,000, right? And then you risk 0.5% on 2 of the remaining trades and you lost them, which means you have made a profit of $2,000 and you have also lost $1,000. So at the end of the day, you have your $1,000 target or profit for the day made, even though you lost trades. Now think about you winning 3 of the trades and losing 1. Of course, you know that in a month you should be able to cash out $10,000 repeatedly every month. Now think about that in a year. Think about how much, because I know some of the months you're going to cash out big, you're going to receive big payouts that are more than $10,000, because obviously sometimes the market will do crazy things and give you substantial profits that will blow your mind. So in some months you're going to be receiving between $10,000 to $15,000, $16,000 depending. So just picture that and what that will do to you and for you in the next 1 to 2 years from now. That will basically give you a good amount to fund your personal account and trade personal account. Now I have a video I am preparing, which is plan on how I will make $200,000 in pure profit from profit account next year. Now if you want me to speed up that video, then leave your comments in the comment section below. Just basically tell me you want to see the video. Now this includes every detail you need to know and everything you need to hear or put down or acknowledge in order to help you achieve that goal. It includes the ups and the downs, the risk and the fantasies. Every other thing in between is calculated just to make sure you arrive at that destination of 200k in pure profit and even more by the end of 2025. Now that being said, let's hop on to tip number 5, which is the final one, and this one is very important. Learn to leave the market and the chart alone to refresh your strength, your energy, your thoughts, your psychology, and of course your breath. Sticking to the chart long enough every time will always start negative psychology in you. So it is better whenever you feel like you're bored, whenever you feel like you're no longer seeing things that you want to see, and you have the feeling of trying to force yourself to see things that the chart isn't really showing you, then it is time for you to stand up from your chair, leave your desk, and walk away. Just go have some other conversation, have some fun, take a walk, go see some sights. Just walk around, refresh your mentality, have different conversation with people, go visit someone, just distract yourself from trading and come back later when your mind, your energy, your spirit, your soul, your thoughts, your psychology, and your breath are refreshed. Then you will begin afresh to understand what the chart is presenting to you, other than trying to present your idea to the chart. Now, I believe these 5 tips helps you. Put them into practice and you will begin to see changes in your trading business. And with that being said, we've come to the end of this video. Now, remember that every day I try my best to put out video recording of daily analysis showing you what the chart is likely to do, the direction the chart is likely to go, and everything in between. And this means that I will show you that if the chart doesn't do this, then expect it to do this other one. Now, if it does this other one, this is the next thing you should expect. Now, how about it does this? This is also what you should expect next. So I go over the instruments that I analyze and I break them down for you, telling you things to expect. And now this is not meant to be a trade call for anybody. Rather, it's meant to be an educational video where it helps you make better trading decisions in your own style of trading. If that sounds like what you want to see every day, then do well to make it a date with me here every day that I drop the video. And making it a date with me means subscribing to the channel and hitting on that notification bell so you get notified every time I drop this video. And I really wish you well in your trading journey, and I will see you in my next video. Hopefully catch you.